Mark, the Strait is still closed. The conversations, the negotiations continue. Fresh strikes by the US. What do you make of the market reaction so far?
I'm struggling a little bit right now, Tom. Look, I think the way you've got to look at this is March, we traded the war. Since April, we traded the idea that the tail risk on the war was kind of ruled out because they're going for a ceasefire, and therefore let's get fully invested in the AI kind of stock market boom again. I kind of actually, that narrative made sense to me, both the trade in the war in March and trade in the more positive scenario in April, until about a week ago. And the reason I'm now struggling with the fact that we're still trading the AI boom is that the tail risks of the war are back on the radar. While we seem to have completely discounted the idea of a major military escalation, which I'm already a bit suspicious of, we have another tail risk, that the Strait just doesn't reopen. Doesn't even matter if there's no military re-escalation. It's now almost 3 months. It'll be 3 months this week for the Strait still being closed. And I think the economic damage continues to deepen, and yet we're continuing to ignore it. And so I think that disconnect between AI and the rest of the world has to close at some point. Now, it obviously can close positively if we do get some wonderful grand deal announced soon, where the Strait actually gets reopened, not just promised. But unless we get that scenario, I think they reconnect in a much more negative way. And that's why, having been fine with the narrative up until about the last week, I'm now turning more negative and more bearish and more gloomy about it all.
Yeah, well, Mark, I was going to say, if you want to trade the AI trade, then you get exposure to equities. If you want to trade the macro, then you probably have to look at commodities and fixed income markets here.
Yeah, I think the commodities one is a much more long-term theme. But unfortunately, some of the commodities are trading like AI meme stocks. So I think it's one of these classic cases where we got a disconnect in time spans of how people want to trade this. I think in short-term trading dynamics, it is very dangerous in some of the commodity space. But I think things like copper have a very much a structural story. They're overheated around that at the moment. The structural story is good. They become more like the AI trade than the infrastructure build-out trade. I think in fixed income, it made sense that we were negative bonds the last few weeks. I think the story on bonds is turning a little bit more nuanced because growth issues are going to become a factor the longer the Strait stays closed, and therefore I think long end yields are going to have certainly some kind of flattening pressure come in as well.
Okay, so flattening pressure on long end. Do you think overall, Mark, the bond markets have priced this and gotten this kind of a clearer read on the risks around the Straits of Hormuz? I mean, is there potentially an opportunity for a bond rally if the market, or at least if the Strait reopens?
I think there is short term, but you got to remember that the inflationary impact of the war will linger even if there's a resolution here, just because oil prices stayed high for so long, and we're seeing a little bit of a change impact in inflation expectations. So, yeah, there'll be a short-term rally, but not long-term, and also because part of the bond sell-off was around fiscal concerns. As for whether bonds have largely got this right, I'm always biased that bond traders get these things quicker than stock traders, but that's a separate issue.